Warren Buffett is known as one of the world's wealthiest and most successful investors. His fortune exceeds $100 billion, and his investment strategies have made him an icon in the finance world. However, his journey wasn't always smooth. It took decades of learning and experimenting to perfect his investment methods. In this video, we'll explore how Warren Buffett built his billion-dollar fortune and discuss the key lessons from his approach to money and investing. Early life and beginnings. Warren Buffett was born in Omaha, Nebraska in 1930 during the Great Depression. His father, Howard Buffett, was a stockbroker and U.S. congressman, while his mother, Lila, was a homemaker. From a young age, Warren was fascinated by business. By age 6, he was already buying gum and soda bottles, reselling them door to door. This early entrepreneurial spirit would set the stage for his future endeavors. At age 11, Buffett made his first stock purchase, 3 shares of City Service, preferred at $38 per share. Unfortunately, the stock dropped to $27 and Buffett sold it, only to see it rise to $40 shortly after. This lesson in patience would stay with him for the rest of his career. By 14, Buffett had filed his first tax return, declaring a $35 deduction for his bicycle used to deliver newspapers. His dedication to business continued as he saved over $5,000 before finishing high school. But it was at the University of Nebraska that he was introduced to Benjamin Graham's The Intelligent Investor. This book laid the foundation for his investment philosophy, value investing. Buffett went on to attend Columbia Business School, where he met Benjamin Graham, his idol. Graham's philosophy of value investing deeply resonated with him, and this is where Buffett's approach began to take shape. Value investing involves buying undervalued stocks, holding them for the long term, and focusing on businesses with a sustainable competitive advantage. The turning point. After graduating from Columbia in 1951, Buffett joined Graham Newman Corp., where he gained valuable experience in stock picking and investment strategies. But by 1956, Buffett left to start his own investment firm, Buffett Partnership Limited. He focused on buying undervalued companies and turning them into profitable businesses. Buffett's breakthrough came when he bought shares in Berkshire Hathaway, a struggling textile company. Buffett initially bought Berkshire for its undervalued stock, but later realized that the textile industry was not a good fit for his investment philosophy. Still, he increased his stake in the company and eventually took control. At this point, Buffett made a critical decision. Instead of focusing solely on textiles, he began using Berkshire Hathaway as a vehicle for acquiring other businesses. By the 1960s, Buffett had fully shifted his attention to acquisitions, buying companies like National Indemnity, which helped Berkshire's cash flow grow significantly. Building Berkshire Hathaway's growth under Buffett was not accidental. Buffett focused on acquiring businesses with strong management, good financials, and the potential for long-term growth. His investments weren't about making quick profits, but about building a strong portfolio of diverse, well-run companies. One of Buffett's key strategies was buying companies outright, instead of just stocks. In the 1970s, he acquired See's Candies, a business with a strong brand and loyal customers. He also invested in American Express and Coca-Cola, companies that would deliver solid returns for decades. As Berkshire Hathaway's portfolio expanded, so did its success. Buffett's focus on buying businesses that could thrive without constant interference from him made him stand out from other investors. His long-term strategy of holding companies for years or even decades allowed his investments to grow significantly over time. By the 1990s, Berkshire Hathaway's stock price had skyrocketed, and Buffett was a household name. But it was his philosophy of value investing, along with his disciplined approach to acquiring high-quality companies, that helped build his fortune. The philosophy of long-term investing. Warren Buffett's investment strategy is centered around the concept of long-term value. Unlike many investors who chase quick profits, Buffett invests in businesses he believes will continue to grow over time. His famous saying, "Our favorite holding period is forever," reflects his commitment to long-term gains. Buffett doesn't just invest in any business. He seeks companies with a sustainable competitive advantage. Companies with strong brands, solid management, and a business model that can withstand market fluctuations are the types of investments that Buffett makes. These companies are typically undervalued in the market, presenting a buying opportunity for Buffett. Buffett's long-term strategy has allowed him to build a diverse portfolio of businesses that generate steady cash flow. He emphasizes the importance of patience, often stating that the key to successful investing is to not sell a good company once it's acquired. One of the key advantages of long-term investing is the power of compounding. Over time, reinvested profits grow exponentially, allowing Buffett's wealth to snowball. He's also never been interested in trying to time the market. Instead, Buffett buys quality companies at attractive prices and holds them for decades, the role of mistakes and learning. Warren Buffett has made mistakes throughout his investing career, and he's always been open about them. One of his most famous mistakes was investing in the textile business of Berkshire Hathaway itself. Buffett later admitted that this was a poor decision, but he learned from it and used it as a stepping stone to refine his investment strategy. Another mistake was his early decision to avoid the airline industry. Buffett once called it a death trap for investors due to its volatility. However, in the 2010s, he bought stocks in major airlines only to sell them at a loss in 2020 during the COVID-19 pandemic. These mistakes show that even Buffett is not immune to making wrong decisions, but his ability to learn from them and move forward is a key reason for his long-term success. Buffett believes that mistakes are opportunities to learn. He has said that the most important thing in investing is to avoid making the same mistake twice. His ability to learn from errors and adapt his approach has been crucial to his continued success, understanding market cycles and timing. Warren Buffett's investment philosophy also includes an understanding of market cycles. While he does not try to time the market, he takes advantage of market downturns to purchase companies at discounted prices. His famous quote, "Be fearful when others are greedy and greedy when others are fearful," speaks to the idea that market cycles provide opportunities for smart investors. During the 2008 financial crisis, Buffett took advantage of the market's panic, investing in companies like Goldman Sachs and General Electric at prices far below their intrinsic value. These investments paid off significantly when the market recovered. Buffett's understanding of market cycles has allowed him to buy businesses at the right time, which has contributed to his success. Buffett's investment principles. Warren Buffett's investment principles are straightforward but powerful. He looks for businesses with a strong competitive advantage, capable management, and consistent profits. He avoids industries he doesn't understand and focuses on companies with predictable earnings. Another key principle is the importance of a company's management. Buffett is known for saying that he invests in companies with managers he trusts and admires. He believes that great management is crucial for a business to succeed over the long term. Buffett also emphasizes the importance of a company's moat, a competitive advantage that protects it from competitors. This could be a strong brand, patents, or a unique business model. Companies with a wide moat are more likely to succeed over time, which is why Buffett seeks them out. Philanthropy and the Buffett legacy. Warren Buffett has made it clear that his fortune will not be passed down to his heirs. Instead, he has pledged to give away 99% of his wealth to charitable causes. Buffett's philanthropic efforts have been a significant part of his legacy. He teamed up with Bill and Melinda Gates to create the Giving Pledge, encouraging the world's wealthiest individuals to give away the majority of their wealth. Buffett's decision to give away his fortune is rooted in his belief that wealth should be used for the greater good. He has often said that the best way to use his money is to help others, and his charitable donations have had a significant impact on causes ranging from education to healthcare. Conclusion. Warren Buffett's journey to wealth was not an overnight success. It was the result of decades of learning, refining his investment strategy, and sticking to a long term philosophy. His key principles: buying businesses with strong fundamentals, holding investments for the long term, learning from mistakes, and taking advantage of market cycles have been the foundation of his success. Buffett told the story as a powerful reminder that wealth is built over time with patience, discipline, and a clear strategy. Whether you're just starting your investment journey or are already an experienced investor, adopting some of Buffett's principles can help you build wealth and achieve long term financial success.